Two people can save for the same 30 years, retire on the same day, and still end up with very different amounts of spendable money. Not because one picked better investments, not because one saved longer, because they used different accounts. Ryan maxes out his 401k, Daniel maxes out his Roth IRA. Both think they handled retirement exactly right, but Ryan hasn't counted what the government may take when he withdraws the money. And Daniel hasn't counted what paying taxes upfront cost him along the way. Once you follow both accounts through an entire retirement, the balances on paper stop telling the full story. So let's make the comparison fair. Ryan and Daniel are both 30 years old. They each earn $75,000 a year. Same city, same tax bracket, same basic goal: retire comfortably and not spend their later years stressing about money. The only thing we're changing is the account they choose. Ryan signs up for his company's 401k. His employer matches 4% of his salary, dollar for dollar. That comes out to $3,000 a year in free money. Ryan contributes 10% of his salary, or $7,500 a year. Add the $3,000 match, and $10,500 lands in his 401k every year, all before taxes. The hit to his paycheck doesn't feel nearly as bad because Uncle Sam hasn't collected taxes on that money yet. Daniel takes a different route. He opens a Roth IRA and contributes the maximum $7,500 a year. He gets no employer match and no deduction today. Every dollar entering that Roth has already been taxed. So Daniel feels the cost in his paycheck immediately. Ryan's balance grows faster, and people at work start asking what he's investing in. Daniel mentions his Roth IRA and usually gets a polite nod. Roth IRAs just don't sound very exciting. Nobody takes over a backyard barbecue to brag about paying taxes early. But what feels impressive and what works mathematically aren't always the same thing. During the first few years, Ryan clearly looks like the smart one. His $7,500 contribution reduces his taxable income by the same amount. At his current tax bracket, that saves him about $1,650 in federal taxes every year. That money stays in his pocket right now, not decades from now, not after some future rule change. Ryan gets that benefit today. Then the employer match makes the comparison look even more one-sided. Ryan contributes $7,500. His company adds another $3,000. With investment growth included, he finishes year one with roughly $11,200. By year three, the account is worth about $36,000. By year five, it has passed $64,000. More than $12,000 of that came directly from his employer. Ryan didn't have to earn that money, save it from his paycheck, or pay taxes on it before it entered the account. Daniel's Roth IRA reaches about $46,000 by year five. That's still a strong start, but it's clearly smaller than Ryan's balance. And Daniel funded every dollar with money that had already been taxed. At a 22% marginal tax rate, Daniel effectively had to earn around $9,600 in gross income to have $7,500 available for his Roth IRA. Ryan only needed $7,500 of gross income to put $7,500 into his 401k because the tax bill hasn't arrived yet. Ryan has the larger account, the larger paycheck, and $3,000 a year coming from his employer. On every scoreboard he can currently see, he's ahead. And Ryan knows it. What he doesn't see is that every dollar inside his 401k comes with a future tax bill. The envelope just hasn't been opened. There's a reason the 401k is the most widely used retirement account in America. Getting a tax deduction today feels great, but delaying a tax is not the same as making it disappear. A traditional 401k gives Ryan tax deferral, not tax elimination. Every pre-tax dollar he contributes, along with every dollar of investment growth, is taxed as ordinary income when he withdraws it, not at long-term capital gains rates, not at some special discounted retirement rate. It's treated like regular income, basically the same way a paycheck is treated. If Ryan withdraws $60,000 a year after retiring, the IRS looks at that as $60,000 of income. After the standard deduction, he could owe roughly $5,000 in federal taxes every year. So the balance on Ryan's statement isn't entirely his. Some unknown portion already belongs to the IRS. The exact amount depends on his future withdrawals, his future tax bracket, and tax laws that may not even exist yet. Then there's a rule that surprises a lot of retirees. Starting at age 73, Ryan has to begin withdrawing money from his 401k, even if he doesn't need it. These are required minimum distributions, or RMDs. The IRS won't allow tax-deferred money to stay in the account forever. If Ryan's 401k reaches $2.6 million by age 73, which is realistic with 7% annual growth, his first required withdrawal would be roughly $98,000. He can't simply leave it invested. That withdrawal is taxable income, and it could push Ryan into a higher tax bracket than he had while working. His Social Security can also get pulled into the tax calculation. Withdrawals from a 401k count as income when the IRS determines how much of his Social Security benefits are taxable. Once his combined income crosses certain thresholds, as much as 85% of those benefits may become taxable. Ryan spent his entire career paying into Social Security, and now part of it can be taxed because he's taking money from his own retirement account. That's one of those details people often discover after they've already retired. Accessing the money early creates another problem. If Ryan needs cash before age 59 and a half, he generally owes ordinary income tax plus a 10% early withdrawal penalty. Say he has an emergency at age 50 and pulls out $30,000. Between taxes and penalties, that withdrawal costs him roughly $9,600. He ends up with only about $20,400 to actually use. That's a steep price for accessing money sitting in an account with his name on it. None of this makes a 401k a bad account. It just means Ryan shouldn't treat the number on his statement as money he can spend dollar for dollar. Part of that balance belongs to the IRS, and he won't know exactly how much until he knows the tax rates and withdrawal rules of the future. But focusing only on the 401k's weaknesses would be just as misleading. Daniel's Roth IRA has limitations that its biggest fans tend to move past pretty quickly. The most obvious one is the contribution limit. In 2026, Daniel can contribute only $7,500 a year. Ryan can contribute as much as $24,500 to his 401k, which is more than 3 times the Roth IRA limit, even before adding an employer match. If both men wanted to shelter as much income as possible, the 401k wins easily on capacity. Daniel also gets no employer match. Ryan receives $3,000 every year just for contributing enough to earn it. Over 32 years, assuming compound growth, that match alone becomes roughly $354,000. Daniel has to build every dollar of his balance himself. The Roth IRA also comes with an income ceiling. If Daniel's career takes off and his income rises above $153,000 as a single filer, his ability to contribute begins phasing out. Once he earns more than $168,000, he can't contribute directly at all. Backdoor Roth strategies may still be available, but they add another layer of complexity, and most people never bother with them. There's also a less visible cost. Paying taxes up front means that money can't be invested somewhere else. Daniel pays roughly $1,650 more in federal taxes each year because his Roth contribution isn't deductible. Over 32 years, that adds up to about $52,800 in taxes Ryan didn't have to pay during those same years. That difference matters, especially if Ryan does something useful with the savings instead of spending it. If Ryan invested that $1,650 yearly tax savings in a regular brokerage account earning 7%, it could grow to nearly $195,000. That's real opportunity cost for Daniel. And there's another possibility Roth supporters don't like discussing. If future tax rates fall, Daniel may have paid too much by locking in today's rate. Lower rates seem unlikely with the national debt where it is, but unlikely doesn't mean impossible. For the first 5 years, Ryan's lead is easy to see. Somewhere around year 7, though, that lead begins growing more slowly. By year 10, the story underneath those account balances starts to change. Ryan's 401k, funded with $7,500 a year plus the $3,000 employer match, is worth about $155,000. Daniel's Roth IRA, funded with $7,500 a year and no match, has grown to roughly $111,000. On paper, Ryan is ahead by about $44,000. That looks like a comfortable lead, but how much of Ryan's $155,000 can he actually keep? If the money is taxed at 22% in retirement, about $34,000 belongs to the IRS. Ryan's after-tax wealth is closer to $121,000. Daniel's entire $111,000 is his, with no future tax bill attached. The gap is already much smaller than it looked. By year 20, Ryan's 401k balance is around $461,000. Daniel's Roth IRA is worth about $329,000. The statement says Ryan is winning by $132,000. But if Ryan liquidated the account at a 22% tax rate, his after-tax value would be roughly $360,000. Daniel keeps his entire $329,000. Now the real difference is only about $31,000, and nearly all of it comes from Ryan's employer match. Remove that match, and the two men are almost even. This is the part that throws people off. Ryan's 401k looks larger on every statement every year for the entire time he owns it, but a meaningful share of that money was never fully his. It was the government's portion sitting inside his account, waiting to be collected later. Daniel's Roth balance looks smaller, but there's no hidden claim against it. After 32 years of consistent investing, both men retire at age 62. Now the comparison becomes real because they're no longer looking at account balances. They're about to start living on the money. Ryan retires with approximately $1,238,000 in his 401k. He's officially a 401k millionaire, at least on paper. Over his career, his employer contributed $96,000 in matching money, and compound growth handled the rest. It feels like a huge win after more than 3 decades of saving. Daniel's Roth IRA is worth approximately $885,000. He never crosses the 7-figure line, so he gets fewer bragging rights at the retirement party, but all $885,000 belongs to him, tax-free. Both men begin withdrawing $60,000 a year. Ryan takes $60,000 from his 401k, and the IRS treats it as ordinary income. After the standard deduction, his taxable income is about $44,300. His federal tax bill comes to roughly $5,100, leaving him with about $54,900 to spend. If he lives in a state that taxes income, he may owe even more. Daniel also withdraws $60,000. Because it comes from a qualified Roth IRA, his federal tax bill is $0. His spendable amount is the full $60,000. Same withdrawal on the statement. Very different amount in the bank account. That's a difference of about $5,100 every year. Across a 25-year retirement, Ryan pays roughly $127,000 in federal taxes just on his 401k withdrawals. Daniel pays nothing on qualified Roth withdrawals. Then Social Security enters the picture. Assume they each receive $24,000 a year in benefits. Ryan's 401k distributions increase his combined income enough that up to 85% of his Social Security may become taxable. That could add another $2,400 a year to his tax bill, simply because of where he kept his retirement savings. Over 25 years, that's approximately $61,000 more. Daniel's Roth withdrawals don't count toward that combined income calculation, which may allow him to keep more of his Social Security tax-free. Add both costs together, and Ryan could pay somewhere around $188,000 in federal taxes over a 25-year retirement on money he believed was already his. Daniel could pay close to $0. Ryan still began retirement with the larger account, but the difference in spendable wealth is nowhere near the difference shown on their statements. If future tax rates rise, Ryan's disadvantage grows. Now imagine something neither of them included in the plan. At age 50, both men suddenly need $30,000. It could be a medical expense, a family emergency, or an opportunity that requires cash immediately. Ryan turns to his 401k. Because he's younger than 59 and a half, the early withdrawal penalty takes 10% or $3,000 right away. He also owes income tax on the full $30,000 at his 22% marginal rate, costing another $6,600. Ryan withdraws $30,000 but walks away with only about $20,400. He needed the full amount and received roughly 2/3 of it. Daniel goes to his Roth IRA. One of the Roth's least understood features is that contributions can be withdrawn at any age without federal income tax or an early withdrawal penalty. That applies only to contributions, not investment earnings. By age 50, Daniel has personally contributed $150,000 over 20 years. He removes $30,000 from that contribution basis, no $3,000 penalty, no $6,600 tax bill. The full $30,000 is available for the emergency. Same age, same needs, same withdrawal request. Ryan loses $9,600. Daniel loses nothing to taxes or penalties. That flexibility makes the Roth IRA useful for more than retirement. Its contribution basis can act like a backup emergency fund, although pulling money out still means giving up future tax-free growth. But if we stopped here, we'd only be telling the Roth side of the story. The 401k has structural advantages the Roth IRA simply can't match. The employer match may be the best return available in personal finance. If a company matches 4% and you contribute at least 4%, that portion of your money receives an immediate 100% return. Ryan's employer contributed $96,000 over his career, and compound growth turned those contributions into roughly $354,000. Daniel has no equivalent benefit. The match by itself can be worth more than the Roth's entire tax advantage for many workers. The 401k also provides much more room to save. In 2026, Ryan can contribute up to $24,500, while Daniel's Roth IRA is capped at $7,500. For someone in peak earning years who wants to move as much income as possible into a tax-advantaged account, that difference is enormous. The current tax deduction can also work in Ryan's favor under the right conditions. Suppose someone pays a 32% marginal rate while working but expects to withdraw money in retirement at the 12% or 22% rate. A traditional 401k allows that person to defer taxes while the rate is high and pay them later when the rate is lower. That difference becomes a real financial gain. For high earners who make too much to contribute directly to a Roth IRA, the 401k may also be the only simple tax-advantaged option available without using backdoor strategies. And there's a practical benefit that doesn't show up in a spreadsheet: forced consistency. The contribution leaves Ryan's paycheck automatically before he has a chance to spend it. He doesn't need to remember to transfer money each month, and he can't accidentally use it for something else. For people who struggle to invest regularly, that automatic system may matter more than a theoretically perfect tax strategy. A plan only works if you actually follow it, and payroll deductions make following the plan much easier. The Roth IRA wins in a different set of situations, and those situations are becoming more common. If you're young and early in your career, perhaps earning $40,000 or $55,000 a year, you may be in one of the lowest tax brackets you'll ever see. Paying tax on your contributions at that lower rate today, then receiving decades of growth tax-free, can be a very strong trade. The Roth also has no required minimum distributions for the original owner. Ryan must start taking taxable money from his 401k at age 73, whether he needs the income or not. Daniel can leave his Roth IRA untouched for the rest of his life. If he doesn't need the money at 73, it stays invested. If he lives to age 90, that gives the account 17 more years to compound tax-free without forced withdrawals. Daniel also has far more control over his taxable income in retirement. If he receives Social Security and a small pension, he can withdraw money from the Roth IRA without adding a dollar to his federal taxable income. Ryan can't do that with a traditional 401k. Each taxable withdrawal increases his income. That control can lead to lower Medicare premiums, less tax on Social Security, and more freedom to decide where each retirement dollar comes from. The Roth IRA can also be cleaner for estate planning. If Daniel dies and leaves the account to his children, they inherit the Roth tax-free. Under current rules, they generally must empty the inherited account within 10 years, but they won't owe federal income tax on qualified withdrawals. Ryan's children can inherit his 401k, but every taxable dollar they remove is treated as income. The account balances might look similar at inheritance, yet what the children keep can be very different. Then there's the risk nobody can calculate with certainty: future tax policy. The United States national debt is above $36 trillion, and federal spending isn't exactly disappearing. No one knows where tax rates will be decades from now. If rates rise even modestly, every pre-tax dollar in Ryan's 401k becomes less valuable after taxes, while every qualified dollar in Daniel's Roth becomes more valuable by comparison. The Roth IRA is partly a bet that paying a known tax rate today is safer than accepting an unknown one later. Ryan and Daniel both left their original decision believing they had found the smarter account. Ryan saw the current tax deduction, the employer match, and the higher contribution limit. Daniel saw tax-free growth, flexible access to contributions, and no required minimum distributions. Neither choice was foolish. Neither choice told the complete story either. For most people, the strongest strategy isn't choosing one account and rejecting the other. It's using both in the right order. First, contribute enough to your 401k to receive the full employer match. If your company matches 4%, that match is free money and gives those dollars an immediate 100% return. There is no reasonable tax argument for voluntarily passing it up. It's one of the best offers available in personal finance. Ryan's numbers make that clear. His employer contributed $96,000 over his career, and compound growth turned that money into roughly $354,000. Giving up the match would have done far more damage than choosing the supposedly wrong account type. After capturing the full match, the second step is to max out a Roth IRA if you're eligible. In 2026, that means contributing up to $7,500. You already collected the free money from your employer. Now you're building a separate pool of assets that can grow and later be withdrawn tax-free, assuming the withdrawal rules are met. This gives you flexibility that a traditional 401k can't provide. In retirement, you can choose between taxable 401k income and tax-free Roth money, depending on what works best that year. If an extra withdrawal would push you into a higher tax bracket, increase your Medicare premiums, or cause more of your Social Security to become taxable, the Roth gives you another place to pull from. It also gives you access to your original contributions before retirement, without federal taxes or penalties. That doesn't mean you should treat it like a checking account. Money removed early loses years of potential tax-free compound growth. But having the option still matters when life refuses to follow the plan. If you still have money available after getting the match and maxing out the Roth IRA, return to the 401k and increase your contributions toward the $24,500 annual limit. The current tax deduction still has value, and the higher ceiling gives you far more room to shelter income. The basic order is simple. Employer match first, Roth IRA second, then additional 401k contributions. This approach combines the strongest feature of each account. You collect the free employer money, you create a pool of tax-free retirement income, and you keep access to the much larger contribution capacity of the 401k. It also reduces the risk of going all in on one guess about future taxes. If rates rise, the Roth side becomes more valuable. If your tax rate falls in retirement, the traditional 401k side may work in your favor. You're not required to predict tax policy 30 years in advance and get it exactly right. You're giving your future self options, and those options can be worth more than trying to declare one account the permanent winner. The real mistake isn't owning a 401k, and it isn't choosing a Roth IRA. The mistake is picking one because of a TikTok clip, a coworker's opinion, or a headline claiming one account always wins. Your salary matters. Your current tax bracket matters. Your expected retirement income, employer match, age, and timeline all matter. You have to run the numbers using your own situation. And there's still another option we haven't compared: putting the money into a regular brokerage account, no upfront tax deduction, no Roth income limits, no retirement contribution caps, and no special early withdrawal rules. That creates a completely different trade-off, and the math may not work the way most people expect. But when someone tells you a 401k always beats a Roth IRA, or that a Roth IRA always beats a 401k, ask one simple question. Did you count everything? Did they include the match, upfront taxes, future taxes, withdrawal rules, Social Security, and opportunity cost? Because the answer that includes everything is the only one worth using.